Well, Harish Krishnan is with us, co-CIO and head of equity at Aditya Birla Sun Life Asset Management Company. Markets, of course, starting lower. Harish, good morning. Good to have you with us here. Our first chat of 2026, so let's hope the remainder of 26 is not how we've started this year off, which has been painful, Harish. And, so many money managers now talking about how they've kind of sort of reoriented and moved to large caps entirely because maybe the call is that in mid and small caps, it'll take time and perhaps there is pain for the foreseeable future. I don't know if you have a view on that specific thought process, Harish.
Happy New Year to you and to your viewers, Prashant. So we do have a similar kind of a construct wherein we do think that larger companies have a far greater risk reward. And this is borne by two particular data points. One is that we do think that, given the fact that there has been a pivot towards consumption, there is a certain amount of focus moving away from B2B franchises, which have done very well from 2020 to 2024. And we do think that there are certain set of sectors and themes which are going to be the winners of the next 2, 3, 4 years, which are markedly different from the winners of the past cycle. So there are 9 sectors which underperformed in the last 3 to 4 years, on which we think at least some of these sectors may end up being the big winners. And if you look at these 9 sectors, which includes banks, which includes IT services, which includes metals, cement, textiles, chemicals, FMCG, oil and gas and energy, etc., overwhelming amount of these sectors have a larger representation in the larger companies rather than in the small cap companies. Flip back 3, 4 years back, wherein the call was more on going into the investment theme. And at that point of time, if you recall, on the PSU side, barring maybe a couple of names, almost everything was in the mid and small cap. If you look at capital goods, barring say 2 or 3 names, everything was in the mid and small cap. And so therefore, there was a greater strength going into the mid and small cap at that point of time. So that's point number one. The second point is that, there has been a lot of money chasing the small caps over the course of the last 3, 4 years. And just to give you in numbers, close to about 23% of the total AUM of the Indian mutual fund industry is into small caps, which is 251 and below, which account for about 11% of total profit pools. So this is a bus which is significantly overcrowded. And while there are a lot of good, interesting names out there which can potentially surprise, we think that the overwhelming risk reward is still with the larger companies at this point of time.
So Harish, getting back to the first point, you're saying 9 sectors had underperformed and you outlined the 9 sectors over the last 2 or 3 years. Now, over the next 12 to 18 months, which of these 9 sectors have enough in their fundamentals to do well and outperform from here on?
So we think that there are 3 particular sectors which are dark horses at this point of time. One is the consumption pack, wherein there has been a significant amount of reset from the government side, which is focused on both tax cuts as well as monetary stimulus. This has been an area wherein companies have kind of focused on margins over volume growth over the course of the last almost 4-5 years. And what we've now been seeing in the last year or so is the focus back on volumes rather than margins. So many of the leading FMCG companies have cut down their margin guidance by focusing on volumes, and have also started using the cash flows to buy bolt-on acquisitions to further their growth agenda. So I think that is an interesting area of point. The second is IT services, wherein while we do acknowledge that there is a threat of the AI, which can kind of disrupt many of the incumbents. The reality is, I think that expectations are running very, very low. This is a space wherein a lot of companies will use a lot of these IT services to actually, do the change as far as AIification of their enterprises. And therefore, for some of them, we do think that this is a great opportunity, especially with the currency where it is in the 90s. We think that that's again a space that can be quite interesting. The third area that we think is a dark horse is the material sector, be it chemicals, building materials. Again, these are spaces where we've seen a significant amount of underperformance. In many of them, there has been a large capex or a large gross block addition, which is not contributing yet in terms of revenues. And so these are the 3 broad areas, along with metals, which has had a great 2025 and which we had kind of picked out as a dark horse at that point of time. We continue to maintain a positive stance. So these would be the areas where we we do think that either there is increasing margin of safety or there is a potential catalyst over the course of the next 18 to 24 months that can drive up as far as value creation is concerned.
All right. Hi, Harish. Good to see you in. And consumption, as you mentioned, various fiscal as well as monetary measures have been put in place to boost consumption. And if I got that number correct, you mentioned in your note around 7 billion USD is the kind of push that we have seen. What do you like out there? If you could drill it down a little bit more.
Sure. So I think on the FMCG pack itself, there is reasonable amount of under ownership. This is like a pack wherein most people have a view that valuations still are expensive, but we do think that there is opportunity out here, even though headline numbers are quite large, are quite steep. The reality is that many of them are throwing significant cash, and we think that incrementally they are headed in the right direction of focusing on volume. So here we have plays which are either into very niche personal care or into the food space, where we are a lot more positive, where the scope for quick commerce led disruption is meaningfully lesser. The other area that we are positive on is in terms of consumer durables. Again, a space where revenue pools are very, very large, but margins are extremely low. And we do think that listing of many of these franchises will bring in certain amount of pricing discipline. This is a space, if you recall, say 5 years back, many of these B2C franchises in the durable space used to trade at 5-7 times price to sales. They've all derated to anywhere between 2 to 3 times price to sales, whereas the B2B franchises, which used to trade at say less than 1 time price to sales, have moved to close to about 4 to 5 times price to sales. We do think that there is a point to transition from the B2B franchises to the B2C franchises. So on the consumer basket, this is where increasingly we are finding value.
Okay, all right. And another point, Harish, which we have discussed in the past as well, that the Nifty in gold terms is at its cheapest that we have seen all the way since the pandemic. But gold, going by the geopolitical tensions that we are seeing, and Mr. Trump, plenty of uncertainty exists in the globe. And that's why, you'll have gold that will continue to hold its own. And maybe the central bank buying as well does hold on. In that case, it'll be difficult for gold to fall from here. But you believe there's a strong case that the Nifty or equities actually outperforms gold from here on?
We do think so. Just go back to the COVID pandemic times. In March of 2020, I would imagine that the overwhelming thought process would be that we are not sure of how our own lives, our own safety would be. Forget about cash flows of companies. And that is where, peak fear psychosis kind of took over. And at that point of time, if Nifty in gold terms had kind of bottomed out, and that's the same level which is bottomed out in at the GFC level, at the .com level, etc. Invariably, living through these motions might always kind of give a sense that, even more worse things are going to come through. And potentially it can. See, all we are saying is from a probabilistic kind of a time frame, given that, over the course of the last 30 years, equities in gold terms have kind of bottomed out here. From a medium term perspective, it does make sense that, one should be increasingly allocated more and more to equities rather than to precious metals. Now, whether this will play out in 3 months, whether this will play out in 6 months, 18 months, 24 months is anyone's guess. It'll only be in hindsight that we'll really know. But my limited point is, when we go through all of these motions as we have during .com, during GFC, during COVID, I'm sure that there would have been peak uncertainty. And each time the nature of the uncertainty and the catalyst of that uncertainty is very, very different. And it will always appear that, these risk-free assets or these safety assets, one needs to really load up on at that point of time. And I'm not saying that, gold will not perform. Don't get me wrong. All I'm saying is that incrementally, one should be better off allocating to equities as an asset class from a medium-term perspective, rather than just purely chasing price action of precious metals.
All right, just take a look at the Nifty, guys. We are breaching crucial levels as we speak. The 20 DMA is gone, the 50 DMA is gone, and now the 100 DMA as well is gone. And we're at the low point of the day, 150 points. Just wondering whether the street is fearing something that's not really come to light as of now, because, we've underperformed last week. And in today's trading session, we're trading for the last 13 minutes and we're down 150 points. The Nifty Bank is trading way below the 20 DMA as well.
Look at the mid-cap
index. Is there something unknown that is plaguing the street as of now?
Nigel, I don't think so. I mean, I think it's just, there is a sense of despondency which is set in. And then you talk to a range of players that becomes very clear on air and sometimes off air as well. That's why I started by asking Harish, a lot of fund managers managing large amounts of money saying that, well, now I'm just sort of protecting NAV, protecting capital, moving to large caps. And some have sort of done it over the last 3-4 months. Some of course, some are doing it now. I don't think there's anything new in that sense the market's responding to. But it's just, there are no triggers at hand. Maybe third quarter earnings, but, again, their expectations are fairly well advertised and little by way of surprise, I think, expected. Maybe in terms of single stocks, etc., here and there, they may be. But on an overall basis, yes, there'll be some strength, etc. But I think, as I said, it's well known and people realize all of that. So without any meaningful turns around the corner, I think it's just kind of a broad sale which is underway. 0.5% lower on the Nifty is what you have. Look at BHEL. I mean, we had Renu with us in the morning, right? Renu Bedab, IIFL. BHEL is down 5.5%. It's the number one volume-led loser on the NSE. And look at Hitachi, which is Power India. It's down 5%. It's under 17,000 rupees now. And maybe we should look at the others as well, right? GE Vernova, and transformers and rectifiers, etc. I'm not sure if this action there. GE is down about 3%. CG and transformers, 4% on transformers, and CG, etc. will also come up on your screen. So, I mean, that's the picture. Just a quick word, Harish, on just that. I mean, it's just a market question more than anything else. I mean, this is not time correction. Let it correct. Let prices grow into earnings kind of a space. I mean, there is aggressive de-risking in mid and small caps, Harish.
Yeah, so I think as you laid out, catalyst in the sense of earnings growth, we do think an incrementally on the margin there is going to be an improving earnings growth, but how much is already in the price? And like I said, the bus is largely overcrowded. When we have, say, 22-23% of total AUM in small cap with 11% profit pool share, we do know that the bus is significantly overcrowded. So it doesn't mean that, you can't create winners out of small caps, but as an aggregate, even if earnings does come through, is there a room for element of surprise? Is there room for element of further buying that can emerge from these kind of names? We kind of think otherwise, and which is where we think that there are pockets of mean reversion rather than looking at the last cycle winners. So I can say that, from a small cap perspective, where we do see value and where we are buying in this fall is a lot of consumer names, a lot of consumer oriented small cap names in the material space, in the consumer durable space. They are available at 3 to 4% cash flow yield, free cash flow yield. I'm not even talking about earnings yield, etc. A lot of them are throwing 500-600 crores of cash flow available at 13,000-14,000 crores market cap with a net cash balance sheet, a lot of capex done. So there is opportunity out here. It is just that a lot of money still is in the winners of the last cycle, and therefore I'm not saying that these names are going to fly through in the next 3 months, 6 months. But we do think that there is opportunity even in the small cap. It's just that the nature of the winners are going to be very, very different. And one needs to therefore view the lens and the opportunity basket from a very fresh lens rather than getting anchored to what we already own.
Harish, we leave the conversation here. Thank you very much for joining in. But we'll watch out for the dark horses that you outlined, which could potentially do well this year: consumer, IT and materials, which includes chemicals, building materials, etc.